What's up everybody, Nate here, and oh how I love fall. The changing of the colors, pumpkin spice lattes, and the existential dread that our entire society and economy might be crumbling all around us, and there's really nothing that anyone can do or say to stop it. Sorry, that's probably just me.
Why would you say that?
Of course, it is October and a brand new month, and that means that the Bureau of Labor Statistics just released the most recent CPI numbers, or Consumer Price Index, for September. And in the theme of being spooky season, the numbers were pretty scary. Generally, for the month of September, inflation did actually decrease by around 0.1%, but that is where the good news ends because pretty much everything else went up on the Consumer Price Index. In fact, inflation now sits at a well over 40-year high of around 8.2%, going up on a year-over-year basis by 0.4%. And this is, of course, with the Federal Reserve raising its interest rates 5 whole times so far in 2022, and the stock market really boomed today as well, with the Dow rising by over 800 points. So what exactly is going on here? Does the stock market actually want to see inflation go up? Well, there's a lot to unpack with what exactly is going on with inflation, so today I want to kind of break down all of the numbers. I want to kind of give you a scenario of what's going to happen if inflation continues to go up, and what's going to happen if inflation goes down, and what exactly all of this is going to mean for our economy in the future. But first, let's go over the CPI numbers for September. So I kind of want to break down just a few things that went up and a few things that actually went down. Some of the biggest takeaways from this consumer price report in September were that most prices, especially when it comes to food, energy, and rent costs, went up pretty significantly for the month of September. For instance, fruits and vegetables went up by around 1.6%, and then we also have cereal and bakery products going up by 0.9%, food away from home going up by 0.9% as well. So those are all things that the vast majority of consumers are spending a lot of money on all of the time. That's not the only things that went up though. We also had rent going way up by around 0.8%. We also had new vehicles going up, and non-alcoholic beverages and airline fares, all of these different things that Americans buy pretty much on a consistent basis. And if Americans are spending a good portion of their paycheck on a lot of these things, then they're not going to have money to put back into the economy. And that is one of the big fears for inflation right now. Dairy products went up by around 0.3%. Meat, poultry, fish, and eggs went up by 0.4% as well. But kind of a silver lining though, alcoholic beverages showed a 0% year-over-year price increase, which is kind of a good thing because we're going to need some of that after reading this report. Now on to the things that actually decreased in price. So gasoline went down by around 4.2%. Apparel also saw a drop of 0.3%, and used cars and trucks actually went down by around 1.1%. Now those numbers are a good sign for the rest of our economy, especially when it comes to used cars and trucks, because those prices have been skyrocketing over the last few years, but it doesn't really help that new vehicles are still going up in price. Now I mentioned before that a basket of all goods and services went up by 0.4% year over year, but if you take out food and energy, prices still went up by around 0.6%. That is a big problem, and it's a big problem for the Federal Reserve. The Federal Reserve has been battling inflation with their only monetary tool, interest rates, and even though they've been raising their interest rates so aggressively, well, that still hasn't had much of an impact on inflation overall. Yes, we are starting to see inflation come down. Just a few months ago, inflation was around 9.1%, so it's around 1 percentage point lower than 2, 3, and 4 months ago. But what you've got to remember is inflation is still extremely elevated, and if Americans aren't making 8, 9, and 10% in a raise every single year, then they're not going to be able to keep up with it, and they're going to end up spending more of their money on all of these other things that they used to be able to buy with less money. That is the issue with inflation. It eats away at the value of your dollars over time, and soon you don't have any money left.
Okay, now that's scary.
One thing I want to mention too here is about Social Security. Now, retirees are going to get an additional 8.7% in a paycheck based on what inflation is right now, and that sounds like a really good thing, except for the Social Security program in the United States already has razor thin margins, and it's expected to be completely depleted depleted by around 2035. If inflation continues to get higher and higher, well, that means that it could get depleted even quicker, which means everyone that's currently putting money into the Social Security program isn't going to see any benefits from that at all. They're basically just putting money into nothing. Now, before I kind of get into the two scenarios of what happens if inflation continues to go up and what happens if it goes down, I want to talk just briefly about what is causing inflation in 2022, because it's not exactly what has happened this year, it's what has been going on for the last 2 or 3 years. At the start of the pandemic, we had lots of money printing by the Federal Reserve through quantitative easing, and also because of a lot of stimulus bills from the federal government. At the start of 2020, we had around $3 trillion in circulation, and now as of today, we have over 20 trillion. That is a lot of money printing all at once, and that means that so much money was circulating around for everybody to use on pretty much anything that they wanted to. Businesses expanded to new record highs. That's why you saw the stock market hit a record high at the end of 2021. Consumers went out and bought things like new cars and houses at record rates. That's why those prices have also gone way up. You're probably noticing a trend here. When you print a whole lot of money all at once, people are going to go out and spend it. And granted, people are gonna spend that money on things that they need, like groceries and energy. But there's also a lot of things that Americans are going to spend money on that they don't need. And that is what ultimately pushes inflation up more and more, is this overspending in our economy. That is the initial problem with inflation, and then it becomes a problem later on because wages don't really keep up. So now Americans are forced to spend more than they can afford because prices are so high. Not only that, but in 2020, the Federal Reserve lowered their benchmark interest rates down to 0%. This kind of stimulated the economy even more. It made it so that people could go out and get mortgages. It made it so that businesses could grow really fast because investors were willing to take on that debt. If your interest rate is 0%, then investors can throw money at basically anything they want, because to get all of their money back, they literally only need a 1, 2, or 3% return on that money. It was practically free. So they saw that as an opportunity, and that's why everything kind of exploded all at once. And like I mentioned before, same with the mortgage market and same with the auto market. But we also had some other problems related to the pandemic that the Federal Reserve and the federal government are not directly responsible for. We had lots of supply chain issues because people weren't really working and we weren't producing a lot of goods, but people were still buying things. So we had one half basically out of work, nothing really happening, and then we had the other half, our finances, basically booming in our economy because the Federal Reserve and the government was printing so much money. So people are spending, but nothing is really getting made. That created a supply and demand problem, and we're still running into those issues today as we still have a lot of money circulating throughout the economy. Not to mention, we've also had in 2022 the war between Russia and Ukraine, and China economic lockdowns causing even more supply and demand problems for not just the US, but for the entire globe. So what exactly is our solution? How do we bring inflation down? Is it to stop spending money? Well, kinda. And this is something that the Federal Reserve has been working on pretty much all throughout 2022. I mentioned before, but the Fed's #1 and basically their only monetary tool when it comes to inflation is their interest rate policies. When people borrow money, they typically go to a bank or some other type of financial institution and they ask the bank for a loan. That loan comes with an interest rate, but have you ever thought about where the bank gets their money? The bank is going to get the money from the currency producer, and that is the Federal Reserve. Technically the Treasury Department, but the Federal Reserve decides how much money actually gets loaned out and printed. So the Federal Reserve gives the money to these banks, and then the Fed has its own interest rate, so the bank has to pay the Federal Reserve back. When interest rates are really low, like they have been over the last 2 or 3 years, that means that these banks have a really easy time loaning out money. They basically got the money for free, so they can charge their interest rates at 1, 2, or 3%. It doesn't really matter, and that's what most people got a mortgage at over the last 2 years. 1, 2, and 3%, historically low. The bank didn't really need to see that big of a return on their money, so they started loaning out money like crazy, and everybody jumped on that as well. It was super easy to get a mortgage, and people were going to be saving money. Like I mentioned before, businesses were exploding, but that continues to spiral out of control because eventually inflation is going to catch up with you. People aren't going to be making as much money anymore, and now businesses have have to pay all of their employees more. And that's not such a bad thing, right? I mean, everybody in the United States wants a raise, but now that people have a raise, they can go out and buy even more than they could before. But businesses haven't really been able to produce enough, so they have to hire more people and build more factories, and that all comes at a cost to them. They then trickle these costs back down to the consumer, who again doesn't make enough money. If this gets out of control though, you have something called the wage price spiral. And like I said, if it's uncontrolled, it just means that wages and prices are going to go up forever. So in order to have some sort of price stability, the Federal Reserve will raise their interest rates. They now want to tighten our economy and make it so it's a whole lot harder for people to go out and spend money. Think of it this way: if interest rates for mortgages go up, well, then a lot of people just simply are not going to be able to afford a mortgage anymore, so they're not going to get one. And if you can't get a mortgage, you're not going to buy a house. And with fewer buyers in the housing market or the auto market or investors on Wall Street, now all of those prices suddenly come back down. And that is exactly what we're seeing in 2022. Prices across the board coming back down because there just isn't as much money floating around. But now here's where things get really complicated this year, and the problem gets really complicated for the Federal Reserve. The Federal Reserve has this monetary tool, right? They can bring down demand and kind of suck out a lot of this money from our economy simply by raising interest rates. People won't be able to get a loan as easily, so everything kind of shrinks. And by that standpoint, well, inflation is going to come down. This is exactly what the Federal Reserve wants. They want businesses to get hit right now because they know that they've exploded in value and in growth over the last couple of years, and they may have even pushed probably too far past where they should be for their fundamentals. They are just way too big at this point in their growth period. So they need to come back down, and as the Federal Reserve continues to raise their rates aggressively and quickly, well, that means that we're going to see a lot of unemployment in the United States because investors are not going to put their money into businesses on Wall Street anymore, and all of these companies need that additional liquidity in order to grow their company. If they don't have it, then simply they're not going to be able to pay their workers like they were in 2021, and they're going to have to fire people. And this is something that the Federal Reserve is predicting. They believe that our unemployment rate is going to go up to around 4.4% by the end of next year. And right now it sits at around 3.5%, which means we could see 1 to almost 2 million jobs lost over the next year. If people don't have an income, then they can't spend any money, and that will drive inflation down because people are going to have to put their house for sale. People are going to have to put their car for sale. People are not going to buy as much at the grocery store or go out to eat or invest in businesses or start their own business because there is no money available. Investors can't invest in a company on Wall Street if interest rates are 5, 6, and 7% from the Federal Reserve. They're not going to see that big of a return on their money basically ever. So they have to be very careful with what they invest in. They want to see a return, and if they can't get a solid return, they're not going to invest. They'll go somewhere else. But the problem is the Federal Reserve can raise interest rates all it wants, but this is pretty much proven to not bring prices down directly in the United States. They have an effect on loaning and they have an effect on businesses, but they don't have an effect on direct prices. Like the Federal Reserve raising interest rates is not going to tell a business to lower the prices of its goods and services. That is all set by supply and demand. So the Fed will have an indirect effect on prices throughout the United States, but because of things like the war between Russia and Ukraine and China lockdowns and supply chain issues, that's going to mean that inflation stays high anyway, and there is quite a bit of corporate price gouging right now going on as well. All of that is not controlled by the Federal Reserve, so with them raising their interest rates, they're going to have to get very, very high before that has a huge effect on anything in our economy, and that is what is coming next if inflation continues to stay high for a long period of time. When I say high, I mean around 2 to 3%. That is where the Federal Reserve likes to keep inflation. You got to understand that inflation is important for our economy for a lot of different reasons. For one, the Federal Reserve and our federal government needs inflation because the more money that is printed, the more the buying power of each dollar in existence goes down. So all $31 trillion of US debt actually gets cheaper the higher inflation that we have. So the US government needs inflation, but we also need inflation inflation because we are a country with growing needs. We need more money as more businesses can be developed, as more people want to get hired, and as more careers and industries boom in the US, we're going to need more money. You can't just have the same amount of money forever. So the Fed does print every single year, but they don't print that much. They want to kind of control our economy so that way inflation and prices don't get out of control either. So the Fed has to continue to raise rates and raise rates. And like I said, that could ultimately send our economy into a recession because now you have millions of people who are suddenly out of work and they have a ton of debt. We have seen debt grow over the last 2 years in credit card debt or in mortgage debt or in just loans in general. People have been borrowing a lot of money to get the things that they want, and that helps boom our economy. But it also means that if people lose their job and can no longer afford that debt, well, somebody's got to pay it. That could be a disaster. So the Federal Reserve right now has to ride the line between not sending our economy into a full-blown recession, but also kind of controlling it enough so that inflation starts to come down. And that's kind of the other scenario. Well, what exactly happens if inflation does go down in our economy? Well, you have to kind of look at this in two ways. If inflation comes down because supply chain concerns go away, the war between Russia and Ukraine ends, and gasoline prices massively decrease in the US because OPEC is producing a lot more, well, that wasn't really Fed induced. So that means that prices will naturally start coming down because that was just demand and supply inflation. But if we have a Fed induced recession or the Fed causing prices to go down by themselves, well, then you're going to see a lot of unemployment. You're going to see a lot of lack of spending. You're probably going to see businesses lay off millions of people and also just flat out disappear over the next couple of years. But if that does bring inflation down pretty significantly in our economy, well, then you probably are going to see the opposite happen from the Federal Reserve. Once they see that inflation is much lower, say around the 2, 3, and 4%, they're going to turn the money printer back on. They do not want our economy to be in a recession. They do not want to see a downturn. They want to see the economy boom, but they have a duty to the United States dollar and the federal government to keep inflation down first. So they're going to worry about inflation first, and that might have a lot of consequences. But if inflation does come down, well, then they're probably going to reverse, flip-flop, and actually start lowering their interest rates again. So that way everything can boom like it did over the last couple of years. Businesses will be able to grow again, people will get hired, but they have to keep an eye on this and keep it controlled, or else we're going to be right back in the situation we were just in. Obviously, I don't have a crystal ball in front of me, so I have no idea what is going to happen next with inflation or what the Federal Reserve is going to do next with their interest rate policies, but I can almost predict that we're going to see pretty huge rate hikes in November and December of this year, and that could have a lot of negative effects for our economy, but some positive effects for inflation in general. And yeah, that all sounds pretty spooky scary, but hey, at least the Federal Reserve is getting in on the Halloween spirit this year.
Not a great plan.
That is it for me, everybody. Be kind out there, and I'll see you all in the next one.